Hi, everyone. Welcome to another episode of Upstream with RiverX. Today, I'm joined by Gavin from BFA Global Investors. Gavin, thanks for coming on today.
Such a pleasure to be here. Thank you.
Yeah, pleasure to have you. And before we get into it, guys, just our standard disclaimer. Anything you hear on this podcast is general information in nature. Please don't consider any of this as personal advice. If you require personal advice, please reach out to one of our advisors and we can get to know you and give you something relevant to your circumstances. But what I might kick off with for the benefit of our listeners is perhaps if you could give us a quick background on who you are, where you're from, and your education and sort of what you're doing today.
Yeah, well, it's such a pleasure to be here. And we've had a great engagement with a number of your team members, a couple of whom I think we've really first met when they came with me in March of last year to Silicon Valley. So we'll talk about that in a moment. But let me give you a little background on BFA and on me. So first of all, a little about me. I'm Gavin Ezekowitz. I'm the Chief Investment Officer, BFA Global Investors. Jonathan Bells and I started the business in 2019, always focused on private assets. We really believe that both in Australia and in Asia, there's the real tailwind in terms of investors increasingly investing in private assets as part of their overall portfolios. And there was an opportunity for us to enter the market. We looked at the market. We looked at the things that people were doing in real estate and said, wow, they're great at that. We looked at some of the things that people were doing in Australian private equity and venture and said, well, let's leave them to that. Where is there a real gap in the market? And the gap is really in the U.S. And interestingly, for Australians, this is an amazing country with plenty of resources, plenty of capability, but very few growth assets, either private or public. And the U.S. market is the place to go globally for growth assets. Now, that has been, of course, the most pronounced over the last few years since the emergence of ChatGPT and OpenAI, and we've this whole AI wave. But even prior to that, it was very clear to us that was the place to focus, and that's where we do focus. So we focus exclusively on U.S. venture, growth, and private equity. We do a little bit in private credit, and we do a little bit in the hedge fund space. And that really comes out of those other things that we do. And we really believe that while people are going to do things all around the world, they should come to us to find those tier one assets in the growth space.
And I think that's been our primary engagement with you. You're seeking alpha in those areas and getting access to good quality offshore opportunities. How do you go about procuring your pipeline? Because I think that's one thing that's key for our investors.
Yeah. Well, it's a great question. And I think, one of the things that we believe is critical is that in the same way that your key business relationship is with those investors and really understanding those investors, part of our key relationship is really understanding investment managers. And we spend 80% of our time in the U.S. I spend about half my life, a little more than half my life in the U.S. I have young kids who live in Southern California, so it's easy for me to be back there anyway, but that's where our assets are. So we spend 80% of our time with investment managers, really understanding how do they create alpha. And 20% of our time is spent on co-investments. Now, most of those co-investments come out of our investment managers. Some of them we call access. Those are companies like SpaceX and OpenAI that people know pretty well, and we really provide a very efficient conduit for them. But at our core, we believe that while there are 3,000 investment managers in America, there are a number of them, as you work down through the list, that really do provide a great deal of value. And our job is to go and find those managers, engage with them, and then create vehicles that make it very efficient for Australian and increasingly Asia-Pacific investors to invest into their funds.
And so you've got a bit of rigor around the investment manager selection process and the co-investment opportunity process. How does that work for you? Do you have an internal investment committee, external asset consultants? Like, what are the layers of due diligence that you would go through to actually make the asset selection once you've identified an opportunity?
Right. It's a great question. And I think it sits at the core of what we do, because at the core of what we do is spending time with investment managers to understand their business and how they make money. And there's sort of two arenas that you want to focus on when you're doing that job. The first one is understanding not just the track record, because in private assets, track records are very ephemeral. There are elements that sit in people's track records that are repeatable, and elements that are best described as luck. Mm-hmm. Nothing wrong with luck. We all like a little luck, but we need to understand what's luck and what's repeatable. And then there's another element which sits around their whole operations and understanding what the risks are to the business of the investment manager. And these things are very different. In the first part, it's about personal relationship. And one of the things that's really interesting in the U.S. is that not every investment manager is available to everybody. You really want to find the best investment managers, and they want to find you as a long-term investor. So there's a lot of relationship. And then on the other side, there are a lot of folks whose business structure perhaps may not lead them to have the kinds of returns you'd look for. And then lastly, as if you're looking at earlier stage investment managers, you want to really understand the sustainability of their underlying business. We do a number of things. Obviously, we have myself and my associate. We've hired a gentleman named Matt Curtolo, who was originally at Hamilton Lane, to work with me. He's got almost 20 years of experience in this space. All he's done is allocating. He helps a great deal. And then we have a firm called Opto, which is a technology and infrastructure firm, which both their own technology, their own investment infrastructure, and then their own third-party due diligence provides us an additional layer of operational due diligence, not so much investment due diligence, but really understanding that the structure of the fund, its administration, is sufficiently robust.
Mm-hmm. And then you mentioned the co-investment opportunities that come from that. So for those who are listening that haven't seen a co-investment before, that would typically be a single position that is held within a broader fund that you might be investing with, and they'll give you an opportunity to tag along and participate in that trade with them on a single asset basis. How do they compare to your sort of pooled investment opportunities? Are they do you get more co-investments or more pooled investment opportunities? What does it look like for BFA?
Well, we're in a markets business, and the cycle currently has there's been a lot of enthusiasm about some incredibly exciting companies. We did a lot of PsiQuantum with you and your team. Of course, quantum computing has gone from something that 2 years ago, when I was in the U.S. and I was walking around speaking with investment managers and family offices and I talked about quantum computing, there was literally no interest. Nobody cared one iota about quantum computing. And today, all these public companies, IonQ and others, have suddenly exploded. And PsiQuantum, a company that's actually going to build the world's first useful quantum computer right here in Australia, it's a U.S. company, but the first one will be in Australia, was a company that we were very close to. Those kinds of companies we generally find through our investment managers, and we create special purpose vehicles with a single asset. And we say to investors, look, you may be invested in this fund where this is one of the companies, but here's a way to get greater exposure to one of the best companies in that fund. And in the case of PsiQuantum, to the quantum computing thematic, which we think has tremendous potential over the long term. In the case of, say, AI, we did a very large transaction investing in OpenAI at the same time that SoftBank did, in the same structure that they did, in a single asset vehicle. And we thought that was a tremendous opportunity at that time, and it's proven out, of course. So we look at those as being a way for investors to get additional exposure in a very direct way, in a very robust structure, where should the asset be IPO'd or sold, they'll get their capital returned the capital isn't retained in a fund or anything like that.
We're finding, obviously, the emergence of private assets is sort of becoming more prevalent, I would say probably in the last 5 years in Australia.
Sure.
I've been investing in them for a lot longer than that, but and I'm sure you have as well domestically and offshore, but it seems to me like investment managers now have more of an appetite for private assets in the portfolios. Are you seeing that trend more and more? The more sophisticated wealth managers, are they coming to you for more of these curated opportunities?
Yeah, absolutely. There's no question that I think we feel we were very fortunate when we started our business. We correctly identified that the trend would become more pronounced. Of course, we couldn't predict all the things that happened. I think what investment managers, investment advisors are increasingly understanding and being able to communicate to their investors is that there is a role in terms of additional performance that an investor can obtain from private assets. And this is where really good investment advisors, I think, are worth their weight in gold. Because for an individual investor to understand the proportion of private assets they may or should have in their portfolio is very difficult. Liquidity is generally the biggest issue people focus on, and liquidity is an important issue. But they need to look at their overall return profile. And one of the things that we identify with, it could be with venture or growth funds or private equity, is that there is an additional return for time. Yeah. And the one benefit that individual investors have is with a portion of their assets, they have time. They don't need it all to be liquid. Yeah. They have time. And we think it's important to create a portfolio of assets that take advantage of time and give you that additional return that time buys you.
And you mentioned liquidity. Obviously, that's something that comes up more and more for us. One of the trends we notice is that some of the vintages from the, the sort of COVID and just coming out of COVID era sort of taking a little bit longer to roll off than usual. And that was because a lot of those businesses went under a bit of hardship during that time. And so a 5-year fund might be becoming a 7-year fund. Are you seeing a little bit of that in the market, a bit of lag in terms of roll off and liquidity in some of those single assets?
Yeah. So I think there's a couple of things. This is a really great point that you raised, because I think this is one of those areas where we can be deceived a little bit by prior performance, both positively and negatively. And the thing to consider as we review the past and we look to the future is when a manager in a new venture or growth fund raises that fund, let's say they're raising it now, they're putting that fresh capital to work in the now current environment with companies with the profile that they see as exciting in terms of growth over the next 5 to 10 years. Some of the dynamics that created the very long return cycles, the staying private for longer dynamics that we didn't want, not the ones we wanted, but the ones we didn't want, around companies that were first built and invested in 2017, 18, 19, 20, those dynamics have changed considerably. So one of them that's really important is you look at many funds, both in Australia, in the US, elsewhere. There's a lot of SaaS companies, okay? Software as a service. Obviously, if you've been reading the news, you're aware that software as a service is a big question mark. How will AI affect these businesses? It could be positive, can be negative. There's a lot of question marks. Also, these businesses have often struggled to create the kind of growth that they might have otherwise had in an environment where their customers are a bit less certain about how they might continue to subscribe to those services. So those businesses are not IPOing as quickly. They're not undergoing M&A transactions as quickly. Those dynamics will probably stay in place for those funds. What's really exciting and interesting, and you can look at companies like Cursor, which was an investment of one of our fund managers. They invested actually at the $5 million pre-seed round, as it happened. Cursor is a company that has a development tool. It's an AI co-pilot. It was one of the fastest companies to $100 million in 20 months, had 20 employees. Okay. It last traded at $40 billion. Okay. Probably has about 100 employees now. The thing about that company is how incredibly profitable it is. So whether it goes public or it's purchased or it buys back stock or it does a myriad of other things, there's no question that the exit dynamics and the growth dynamics for that business are going to produce a vastly different return and an exciting return for investors than what they would have seen had they invested in the SaaS business in 2017 or 2018. That's what we see today. So what we think is it's not unimportant what happened in the past, but we also need to be conscious that all of those dynamics from the past may not carry into the future. In fact, there's some new ones. Yeah,
and we're seeing that now with some of the latest opportunities that we've had. We've seen faster revaluations. I've noticed in the last 12 to 24 months. One of those would be a business that you mentioned just before, PsiQuantum. So we were lucky enough to participate with some of our clients. We entered, was it a $2.6 billion valuation?
Yep, sounds about right.
I think roughly,
depending
on the
sounds
round.
About right.
But I think it was recently revalued, was it to $7?
Correct.
$7 billion I saw.
Correct.
I saw a 10 and a $7 billion valuation in the paper. So that's an example where our clients have got to 2 to 3x in a relatively short period of time. Are you seeing more of that emerge in the marketplace? Like, because especially with things like quantum computing and AI, where we've got a lot of public market and investor interest, their pathway to market seems to be moving a lot faster. Is that a trend that you think is going to continue?
Yeah. Well, look, I think one of the dynamics first of all, I mean, kudos to you and your team, right? Because the dynamics of PsiQuantum at $2.6 billion were a lot less obvious than they are today at $7 billion. Okay. There was not a whole bunch of public companies that were, going up 10% a day or anything like that. So, I think it does take some knowledge, some thought. In this case, a couple of your advisors had visited the company with us in Silicon Valley. I'm sure that helped their understanding. So it does take that work and that understanding to get into 2.6 to then have it revalued. It's not just all, market. There is another dynamic though, which is I think we are in an environment where there's no question that all investors, both in Australia and globally, are underinvested in the kind of growth and the kind of opportunity profile that both quantum computing and AI companies can present over the next decade. And I want to be careful because none of us knows, we've all seen cycles, things price up and they come back and so forth. But at the end of the day, there is a tremendous growth cycle. And this growth cycle really is built on the last 30 years of compute. But there are a number of really interesting innovations, both in AI and in quantum computing, that put it sort of right at the cusp today. And I think many investors in their portfolios are under-invested in that sort of 5 to 10 year window. And we think if you're investing for the long term, you want to be sort of laying out that pipeline of opportunities over time in a nicely diversified portfolio. And yes, our belief is that PsiQuantum is worth an awful lot more once they have a utility grade quantum computer operating in 2028. But we really are focused on where does that take us over the next 5 to 10 years, because we think that's pretty darn exciting.
Yeah, I think it's something that's been very well publicized here, and our team was certainly very excited to get access to the initial opportunity. As you mentioned, so much so that some of them came over to the US with you to look at the facilities. Sure. I think the next most exciting thing will be seeing it in the marketplace. I think that'll be the next big jump forward for that business. But our clients have certainly been happy with the returns that they're seeing on some of these products so far. You mentioned, we were just chatting before the podcast started, and I know there's one live opportunity now, which is the Menlo VC opportunity. I think it would be good if we could just tell our listeners, and our listeners are typically our staff and clients, sure, a little bit about what you're working there, because that's something that we have an active interest in as well.
Sure. Absolute pleasure. So Menlo is a fascinating case because it's a storied firm. The firm has been around almost 50 years in Silicon Valley, early investors in many of the growth companies that you would know. I mean, obviously, the new investment management team and leadership team has not been around for 50 years. They're the last 15 years. But both Matt Curtolo, who works with me in the U.S., and I had known the firm a long time. Matt had actually been investing and allocating to the firm in his prior lives since 2011. He knew them extremely well. I knew them. We went, spent some time with them. And part of what we did in spending that time, of course, is talking to them about the opportunity of an Australian investment community that is underinvested in growth. And when we look at a firm like Menlo, we see a lot of the things that we think investors should have in their portfolios over time. So Menlo had been early investors in Uber, which made them and their investors a lot of money. But around about 2018, 2019, they looked at what was going on in the AI world. At that time, it was probably not as people weren't as conscious as they are today. And they said, we need to lean more heavily. And so they started leaning heavily into AI, and they became early investors in Anthropic, an important company in the space, as you would know. And then they looked across all of their verticals, consumer and SaaS and otherwise. And they said, well, where can we apply this incredible technology in other places? Where is it likely going to apply? And remember, when they're thinking about investing out of their new fund, which they will close up at the end of this year, they're thinking about the next 5 to 10 years. And so Menlo is a great case of a firm that's got a well-established group of founders that they've backed over time. And one of the things that we notice in Silicon Valley is that the great companies often come out of founders that have done it before, maybe even a couple of times before. But those founders almost don't need money, right? I mean, they've got lots of people who want to back them. And so the way you really benefit as an investment manager, as a firm like Menlo, is you've got a long storied history of being their partner. So they come to you first, and they trust you, and they like you, and they think your advice and your network is incredibly valuable. And so that's what we see in Menlo. What we see is a structure that we like. They do a lot of early stage investing in their seed and venture fund, which this is now the fund that's been around forever in various vintages, of course. And then the inflection fund, which is later stage. So the inflection fund is an example. Anthropic's just on a $170 billion investment round. That company's growing incredibly quickly, as you would know. 10% of that fund will be in Anthropic. Okay. And then the balance will be in probably other larger companies that you would be familiar with. We think that that's a good balance for investors, because one of the things that those later stage funds do for you is they give you liquidity a little earlier. So when you're invested in an earlier stage fund, a seed fund, often 7 or 8 years before you get 1 time your money back. Later stage funds, 4, 5, 6 years, depending on the composition of the fund before you get 1 time your money back. Often in a later stage fund, even in the first couple of years, you may see liquidity events because these companies are much closer to liquidity. And so when we look at that composition for investors, we think you've got a tier 1 manager with tier 1 assets, capabilities to invest over the long term, and giving investors some of that liquidity dynamic that we know is so important.
And I think that's a really important point. So a bit of liquidity we mentioned earlier is really important. You would see a certain profile of clients that come to you to seek out these opportunities. And what we're seeing more and more now is you've got your high net worth family office type that are not particularly interested in turning over assets too often, but they'd like a good home, but they can park something. The second part, which is starting to emerge on our side, is we're seeing high net worth investors who have structuring advice around things like succession planning and establishing things like a testamentary trust, which will activate, upon their passing for their children. So we're seeing future planning for the next generation. Is that producing a bit of an uptick in inquiry for you guys, or are you still really seeing a lot more interest from that family office style network?
Well, look, our hope is to work more closely with advisors. In my perfect world, I'm spending more of my time with advisors who are spending time with clients, because of course, there's leverage in that for me. But more importantly, I think the key question that I can't answer for any high net worth investor, ultra high net worth investor, family office, and I get the question all the time, which is, how much should I do? How much should I put into this fund or that fund? How much should I put into SpaceX? Well, I can't answer that question, and I shouldn't answer that question. But an advisor who knows the risk profile and understands the liquidity requirements and is looking at the overall portfolio and where its risk is, can make a good decision, provide good advice. I think to the extent that those investors have that advice, they're going to have an appropriate weight for them that is probably closer to the global weight in private assets over time. And remember, it's over time. Mm-hmm. That, globally, we see anywhere between 20 to 40% of portfolios being in private assets for wealthier individuals. The reality is that that is all about the stage of life, the comfort of the investor, and so forth. But most importantly, and I think, again, this is where advisors play a critical role. Investors will often come to us and say, I'm so underinvested, I just need to go do a bunch of stuff. Mm. And again, we don't see their whole portfolio. We would like them to stage that out over 2, 3, 4 years, because just in the same way you don't buy all your Microsoft today at today's price, you think, oh, I might dollar cost average into it because I want to own this a long time. I think it's a great company, as an example. You're going to do the same thing with your portfolio of both funds and co-investments. You're going to take time. You're going to look at what your allocation needs to be over time, and you're going to make investments in different vintages of funds. You're not going to get too distracted by the Wall Street Journal and, the calamities that invariably occur that cause people to pull back, generally at the worst moment. Mm. You're going to stage it out over time, and that's how you create a great long-term portfolio. That's not what we do. Right? We provide the assets, but it's folks like your team that really provide that advice and give people that structure to create those long-term returns.
Yeah, so we deal with a number of clients that like to work with BFA and BFA style assets, and that's exactly what we're here to do, to act as that conduit. One thing we would note is that I think it could be due to a lack of access or due to a lack of understanding, is that we typically find that assets like yours are underrepresented in Australian investment portfolios. The global averages that we see, like if you look at the UBS Global Family Office report, they're sort of 40% plus in private assets, probably of the total portfolio, 20% in private equity. Mm-hmm. In Australia, in most portfolios that we see, in some cases it's zero. Australians have an affinity with real estate, bricks and mortar. They have an affinity with their CBA and BHP shares, but we don't see a lot of representation of high quality private asset managers internationally, and they're the best managers. Yeah. Like you compare them to what we've got domestically, some of the offshore managers, it's just night and day in terms of quality. So for you, your hope is to work with more advisors. If a client comes to you and says, like that question, how much should I invest? What do you do then? Do you then refer them out to an advisor, or do you just say, look, that's a matter for you? How do you handle that?
So we've actually, strangely enough, and we probably spend more time helping people choose new advisors than we ever thought we would. Because I'll be frank, I think a lot of advisors haven't kept pace with the changes in the market, and their clients are knowledgeable. I mean, the client today is not the client of 20 years ago that had no access. The client knows what's going on. They speak to us directly. But they still need advice. They still need help. And so often it's not a matter of saying either or. It's a matter of and. I need both things. I need them differently. Often it's more convenient to house these assets within an investment portfolio on a platform, one of the platforms, Net Wealth or Hub24 or whatever it may be. And And for the client, it's easier to manage. And the advisor knows their whole portfolio. So I think that the road to proper portfolio composition, as you said, the 40% benchmark, is through advisors, right? Is through advisors. There are plenty of rough cuts that I give both advisors and investors about allocating and risk and so forth. But I think at the end of the day, the advisor sits in a unique position to say to somebody, and more often than not, I have to say this, is you should probably put less into that idea. Mm-hmm. And we should probably find a way for you to invest across a breadth of ideas that are reflective of that same growth profile. So don't invest in only one venture fund. Menlo Venture is a fantastic fund, but you need a portfolio of managers over time. You're not one and done. Let me help you with that. Let me help you with that program. And then that's going to create the great long-term returns for you, right? There is no single co-investment or fund manager or fund that sort of does it all. You're not one and done. You need somebody to give you that full portfolio.
Yeah, I think you're right. And having the depth and breadth of offering is sort of what the leading private wealth managers in our country do a good job of. So I think one of the pioneers in that space might have been LGT. Mm-hmm. It's not Crestone anymore, it's LGT.
Sure.
And some of the more, I would say, boutique blue chip style wealth manager firms out there. But I would say that the regulatory environment is such that it is treacherous to step outside of models, particularly if a client ends up being deemed as a retail investor. So
sure.
I know that if you're dealing with someone like AFCA, they treat the thresholds, the 2.5 million or 250,000 asset position sits there. But if it falls outside of that, ASIC might look at it and say, if they don't have 10 million worth of assets, well, then they're not considered to be a wholesale or professional investor. So we find that the clients that have an interest in your type of products typically sit in that 10 million plus bucket. And that's just purely because they understand the sophistication, they have a desire and appetite for the larger assets, and they can be patient. Because even if they had 40% in illiquid, or if you've got a $10 million bucket, 6 million in liquid, you've got a lot of options if things start going wrong in the marketplace.
Yeah.
I think access to advisors is really key, and coming on things like this will certainly help you with that. If you had your ideal advisor that you're looking to work with, I mean, what are the sort of characteristics that you look for? I know you've mentioned like an understanding of product. Is it connectivity to high net worth investors? Is it a certain positioning of firm? Like, what's your sort of ideal type of advisor you like to work with?
Look, I mean, I'm very realistic about how busy everybody is, both advisors and clients, and the roles that people play. I think a willingness to spend a few minutes to understand the role that these assets can play, and then to reflect for themselves and their clients what works. This is not everything we curate and we bring to the market is not right for everybody. It is not a one size fits all. It's all good for every client. It's really a matter of saying, I think I understand a little bit. I'm interested. I can articulate this to my client, or in some of our best relationships, people, have us alongside them, and they're like, hey, Jane, this is, Menlo is interesting. We can do this. I may not know enough about it myself, but I'm happy to get one of the team from BFA on the line to talk more about it, right? Or to answer your questions, or to get you some information. I know that takes a lot of effort and time. We think it's valuable to do. So our ideal advisor is someone that's interested in that journey, sees it as a differentiator with their client, sees it an opportunity to add additional return, diversification of portfolio. And so I think if we have that person, we believe over time they're going to go and garner more clients, because we know the clients are interested, and we'll all win together. This is a long game. These are long tail assets. So we know that if we start working with someone, we get to know them, we get to know their clients. We'll find lots of opportunities over time.
In terms of platforms and availability, is this something, given their international assets, that you'd have to be on a non-custody style solution to get the reporting live for? So I know Net Wealth Hub, Colonial's going live with a non-custody solution. Premium has their non-custody solution. Are they the type of platforms that you would typically work with? Or is that something that is on a firm-by-firm basis to provide reporting on?
Absolutely. I mean, we have a couple of products that are going on to Net Wealth, onto Mason Stevens. We think that there's plenty of opportunity. Those firms are commercially driven. So if they see the demand from the advisors, they're happy to onboard us. We're happy to price all of this in Australian dollars, transact, and they're all US dollar assets, of course. So there's currency risk, but we're happy to price, take Australian dollars and price in Australian dollars. So yeah, we think that that's the way forward. We have, for some firms, created single sleeve unit trusts, which can be very bespoke for the individual advisory firm. So yeah, I think, look, we're a service provider to folks like you, right? We think we do a great job of the research, curation, education piece of the puzzle. But we then look to you and say, okay, even if we agree this is a great asset, what do you need to make this viable for your firm and for your clients? And then we seek to go out and solve those problems.
Yeah, we've had a great experience so far. And I guess if any of the advisors that in our network are listening to this, how do they find you? Like, where do they reach out to you? Do you guys have a website? Or
Absolutely. Absolutely. So I'm the chief investment officer, but we have a team of 8 folks in our client team. Jonathan Bells, who's my colleague, leads that team. Either of us are happy to speak to anybody at any time. And with BFA Global Investors is you can search that up and find our website. I think you can probably find us pretty easily through your network, and people can send me an email or send me a text, and I'll be happy to have a chat and see what the journey looks like for you.
Yeah, great. Well, look, thanks so much for coming on today.
Pleasure.
It's been an absolute pleasure, and we're interested to hear more about Menlo. So we'll package something up and get that out to clients after this.
All right. Thanks so much, Kieran.
Thanks so
Appreciate
much.
it.
Cheers.
Cheers.